If you're paying attention to any of the news, it's hard to avoid the fact that SpaceX is going public here in the not too distant future.
Figma was worth like 4 times more 2 to 3 days after the IPO. They IPO'd at $33. They moved all the way up to $140 a share. Facebook was down 30% in the first 6 months. Uber was down 30%. So that initial pop that you might have experienced disappeared and then some.
Everything we're talking about here is generally short-term capital gains, which are taxed at the highest tax level, and that just really destroys wealth.
You want to buy early. You want to buy when it's hard to access, when it's at significantly lower valuations, and ride that up. That is taking the casino's seat and not being in the gambler's seat like those people buying the IPO/pre-IPO shares.
We do believe in the private markets. We also believe in the public markets. How does it fit within this whole equation? Hey, everybody. Welcome back to another episode of AWM Insights. It's your host, Justin Dyer, Chief Investment Officer here at AWM, joined as always by Mena, Hanna, our portfolio manager here at AWM. And today's topic, we're going to dive into our IPOs, or initial public offerings. We'll go into exactly what that means, but we thought it's a relevant topic to dive into. We've got a few questions here internally, and if you're paying attention to any of the news, it's probably hard to avoid the fact that SpaceX is going public here in the not too distant future. And there's a ton of other kind of rumors and rumblings of a few other big names that are going public. They're not the only ones. There's more and more companies that are taking this option, this route. We've seen this action has continued. I will say this is not something that just is specific to SpaceX. The volume of companies that have been going public has dropped over the last few years, and we're seeing this pickup. And these big headline drivers are certainly helping that. But more specifically, we want to kind of unpack how we at AWM think about IPOs specifically, and how, if at all, they fit in supporting the multi-generational 100-year family. So without further ado, we're going to jump right into it. Mena, as always, let's just start with the basics. Like IPOs, what are they? Talk a little bit about the SpaceX IPO. As insofar as what we know, right? We know basically what everyone else is reading about. And then you can even take it to say, like, what are the two ways in which people can invest in IPOs? Keeping it really basic. There's probably a lot more than the two that we're going to talk about, but again, just for sake of conversation and education, the two ways that we can access IPOs.
So an IPO, initial public offering, is exactly that. It sounds very simple on paper, but there's a lot of mechanisms. You can sort of simply think about it as you're a private company. AWM is a private company. There's a lot of other, SpaceX is a private company. SpaceX is going to go through a process to release shares into the market and give up some control.
Make sure we talk the market, right? What is the market in this case?
The market is the public market. So right now, all of SpaceX's shares, they're all private. They're all managed in a different way. There's different regulatory also scrutiny, and this listing, which should ideally make the transacting of shares for SpaceX easier. That's typically why companies IPO. That's the benefit here, is you get liquidity. That ends up happening in the public market.
And the public markets can be generally one of two marketplaces, let's call it. So New York Stock Exchange being one, and the NASDAQ being another one. I believe SpaceX is listing on the NASDAQ. So just to bring some names and terminology that I think a lot of people are more familiar with than just like the broad public market.
Yeah, those are the venues. So you have this private company. It kind of actually does, even after IPOing, remain private in some degree, because you have something called a share lockup. So what SpaceX would do is maybe they would issue 20 to 25% of their shares to actually hit the market. Those become public. Now, all of the private investors are just kind of stuck for the next 6 months. They're not able to trade their shares, buy, sell, do anything. I guess you can buy more in the public markets, and you have to wait until 6 months for all of those shares to actually unlock. And I guess the markets in general just think that 6 months, it takes time for that company to stabilize, for investors to have a better read, and then people aren't just ideally going to dump their entire allocation into the markets. Now, you said two things. You said there's two ways of getting access. You can access these shares pre-IPO, so you can do that in the private markets. Sometimes there's also opportunities to buy pre-IPO shares through the banks that are running this public process, or you can buy these shares on the day of actual listing, which that is definitely not recommended.
And then setting us up for the next question I'm going to ask you. So if you're doing pre-IPO, what does that actually mean? Well, let's, again, use SpaceX as an example. Generally speaking, you're buying it at what the published listing price is. So I believe SpaceX, at least the news coverage is saying it's going to be a $1.7 trillion valuation, or 1.78, somewhere in that range. So if you're participating pre-IPO, you're basically locking in that price. And then the hope is that there's a little bit of a pop on day one, as opposed to if you're buying it on day one, hey, if you're getting it right at minute one, okay, maybe you're getting it at close to the same price, or maybe 2 hours in, you're getting it at a pop. So like I said, setting up the next question I'm asking, what happens day one? But arguably more importantly, because to your point, there's always this lockup period, et cetera. Like, what happens long term to these opportunities? Yeah.
What happens, and this is human psychology, there is a pop on day one. So you might think, like, what am I missing here?
Not guaranteed, but it seems to happen.
Typical, right? Yeah. It happens more often than not that there is a pop on day one for a lot of these positions. Now, we've seen this with generational companies, Facebook, Uber. Over the next 6 months, as a pre-IPO investor, you're sort of stuck. You have a pop, you have a nice little green arrow on your dashboard that says, oh, your position's worth 10, 15, 20% more. Figma is actually a great example. Figma was worth like 4 times more 2 to 3 days after the IPO. They IPO'd at $33. They moved all the way up to $140 a share. That looks great on paper, but over the next 6 months, Figma systematically sold off, and there's a whole host of reasons, but we kind of see that across the board. Facebook was down 30% in the first 6 months. Uber was down 30%. So that initial pop that you might have experienced disappeared and then some, and you're in the red. And in the case of Figma, the shares are trading at $25 when all of the shares actually unlock. So you might have thought that you were, being smart, getting ahead of the market. You also probably had a little bit of a pat on the back that was a false positive through just that first initial week pop. And then when it actually came time for you to be able to sell the shares, you're pretty far in the red compared to the market, which was up pretty substantially.
Yeah. Okay. Awesome. Super helpful. So I just want to add some clarity or our take to a couple of those points. So one, let's say you're participating in the pre-IPO, generally you're locked up.
Yeah.
Just as the private market investors, and okay, let's call it 6 months. Data shows 6 months after IPOs, you're not in a good position. So there's no systematic way of generating wealth, building wealth in that sense. Then you could also say, well, okay, let's buy it on day one. And then you're getting into the difficulty of timing markets. All right, yeah, on more often than not, there's a little bit of a pop. When does that pop end? That piece of it becomes really hard to determine. So when do you buy it? On day one matters. Then you go to when do you sell, and that is predicting the future and trying to time the markets. And we know that is just an incredibly difficult thing to do. And we're not even getting into the tax side of things. Everything we're talking about here is generally short-term capital gains, which are at the highest tax bracket, tax at the highest tax level. And that just really destroys wealth. So we always try to think about, we try to think about everything as a systematic way of building wealth, of generating wealth, right? Play the casino, look at the data, look at the odds in our favor, and tilt the odds in our favor. And we just don't see any evidence of that within the IPO topic in general, whether it's the pre-IPO side of things or day one, et cetera. So bringing that to a conclusion, I do want to talk about how we think about investing kind of more holistically, more macro. We do believe in the private markets. We've talked about that. We also believe in the public markets. We've talked about that plenty, but how does it fit within this whole equation? But you also have one last point.
No. I was actually going to talk about the casino and the gambler. So this is a perfect transition.
Awesome.
Yeah.
Go for it. Let me set you up. Within the private markets, again, like I just said, we invest there. We think there's a lot of strong data. There's wealth that can be generated there, especially for that 100-year multi-generational family that can systematically deploy capital into the private markets. And then on the other side of that spectrum is the public markets. Incredible ecosystem of higher confidence, lower returns, but higher confidence in those returns that really can support the 100-year family as well. So just unpack exactly what I'm saying.
Yeah. On the public market side, it pays to be an investor early on and to access these companies at significantly earlier stages than the IPO or even the round before the IPO. I feel like we also see that quite a bit where it's like, oh, we're raising Series E capital, which is really late. They've raised E number of rounds. And yeah, you should get in because we're going to IPO in the next 3, 6, 12 months. Ideally, you're investing at seed stage, at pre-seed, at Series A, and you're building this ownership and establishing this basis when the company isn't worth $1 billion. So you're investing early on. Now, the risk there is a lot of these companies end up failing, but the winners actually more than make up for the losers. So you end up having a significantly higher expected return, and yeah, it's the better time to get in. It's sort of like buying tickets to an event with a capacity of 100 versus 100,000. You are going to get a better experience in that smaller event. That's harder to access, and that is the secret sauce right there. It's not everyone can do it. Not everyone can get in. So of course your experience is going to be better. When you think about the pre-IPO stage, everyone is selling these shares. You can just Google buy SpaceX IPO shares, pre-IPO shares right now, and you can just do it. Now, I was doing the math while we were talking.
Buyer beware on that one.
Yeah, buyer beware. You mentioned 1.7, 1.8 trillion. Some of these shares, the effective valuation is 2.1 trillion. So
because of all the fees and all the craziness on top.
Yeah.
Of it,
So you're getting a worse deal, and that's sort of what happens. You want to buy early. You want to buy when it's hard to access, when it's at significantly lower valuations, and ride that up. That is taking the casino's seat and not being in the gambler's seat like those people buying the IPO/pre-IPO shares. Now, in the public markets, it changes a bit, but it's relatively the same dynamics. SpaceX is going to IPO. SpaceX is going to be introduced into a lot of these indices that we see, the NASDAQ, the S&P 500. That's going to happen. Everyone typically does that in concentrated periods of time. So IPO day is a great example. People just rush in, and that's why we see the pop in price. That's inefficient. Indices do the same thing. When these stocks are being added to an index, added to the S&P 500, and S&P Global kicks another company out, all of these index funds end up buying SpaceX at one time. It's actually like a 15-minute window of time where billions and billions of dollars are just going in one direction, which is never great. And what you're left with is an entry price that's just suboptimal. So in the public markets, what we like to do and how we invest capital is, all right, that the index is going to actually add this. Why don't you just buy a little bit ahead of time, in between sort of the IPO craze and the index craze? That makes all the sense in the world, and it generates real dollars. Not doing that, that's when you're in the seat of the gambler. And if you go back to the early 90s, the difference in performance is pretty substantial. It's roughly 2% when you factor in the IPO pop up, the trend down in performance. It's a 2% deviation in performance between these IPOs over the first 12 months and the public market. So you're kind of systematically losing money, which is what gambling is.
Yeah,
Yeah.
exactly. For those of you who didn't know. Well, cool. I think that's a great summary. Covered, I mean, a focused topic, but in a way, a broad range of topics as well. So kind of just reviewing everything for listeners. IPOs, the data really just doesn't support this systematically. You can buy pre-IPO shares, you're locked up. Generally speaking, when those lockups come to fruition or the lockups expire, prices are lower than the initial offering price, which is the price you probably got it at. So again, not a systematic way of building wealth, taxes aside, which even makes the picture look worse. Same thing with the IPO participation on day one. You're introducing timing, you're introducing short-term gains, super difficult, and again, a non-systematic way of building wealth, and really, you're just gambling in that sense. And we never want to think about investing as gambling. Then extending that beyond, we have how we think about private market investing, which IPOs is a incredibly important step on the journey of private market investing. But we just want to participate very early, at the earliest stages. These companies grow, go public, or are acquired. But in this example, we're talking about companies going public. It's super important, unlocks liquidity, but the valuation difference there, whatever happens on day one or whatever happens between day one and the lockup expiring, is just not as significant really to us when we're thinking about investing that way. And then on the pure public side of things, you talked about indexes and the inefficiency and forced buying and forced selling. Never want to be in that position. We want to be thoughtful. We want to take the best of indexes, be low cost, but then also invest in a way that just doesn't bring frictions to the portfolio, which end up costing money. So hopefully this whole conversation was super helpful. There's a lot within this. So if you have any additional follow-up questions about what's going on with respect to IPOs or just anything kind of more broadly with this conversation, shoot us a text.
626-862-0355.
And hopefully this was a helpful conversation in general. But until next time, own your wealth, make an impact, and always be